Do commissions impact performance at all on a high cash value life insurance policy? We are going to take a look at a case study here. In case you have not seen our overview video, let's quickly recap and provide an answer to this question. Do commissions impact performance? The answer is yes and no. Very quickly, to answer the question with the answer no, the reason why commissions do not impact performance is, let's say you work with me as your agent and we design the perfect policy together. And then you state, you know what? Thanks for the policy. I'm going to go work directly with the insurance company because I do not want any commissions to come out of my performance. Well, what you would find is that the policy would actually perform in the exact same manner whether you work with an agent or not. The insurance company actually takes a haircut by paying a commission to the agent for that business they otherwise would not have had. So if the policy is designed by an agent or not, if all things are equal, commissions will not be impacted at all. Then the other side, when I state yes, commissions do impact performance, that really has more to do with the policy design. And we're going to illustrate this in this example here as we look at it in a minute, in the sense that our money can go where in a life insurance policy? Towards the premium or the PUA component. And we always talk about how to maximize the cash value by reducing that premium as much as possible. Well, what you will find is that the base premium is the number one driver of the compensation, of commissions. So naturally, when we lower that premium, we enhance policy performance, but at the same time, that reduces agent commission. So the question is, does that impact performance short-term, long-term, if I were to look at a side-by-side example? Let's take a look here. So in this case study, we are going to look at a 35-year-old male funding a policy for a very long period of time, up until he's 65, with $50,000 per year. We're going to look at two options here. First, a 1090 split, which means of that $5,000, we've got the premium of that $50,000, we've got the premium at a minimum of $5,000. With this particular insurance company, that's as low as we could go. The rest is being allocated toward the PUA component. So 10% premium, 90% PUA. That's what we mean when we say 1090 split. Compared to option two, we are going to look at a 25-75 split, meaning of the $50,000, 25%, $12,500 is allocated toward the base premium. 75% is directed toward PUAs. So we've got both options here to provide a little bit more transparency here, just so you can understand the numbers when you see them. Here is the commission schedule with this particular insurance company. On the base premium, year one, the commission rate is 93%, and that is as high as it goes with this particular company. To get to this level, if you're an agent in the business, you do need to produce or bring them a lot of business and work your way up to that. But we're assuming top rates here with both examples. Years 2 through 10, they pay a 5% renewal. And then after that, since we're funding for 30 years here, they continue to pay a renewal. They will refer to it as a service fee of 1%. So there's still some compensation paid. And again, these have no impact on policy performance. This is the insurance company paying the agent a commission for helping them keep that business on their books. And then on PUAs, 2% commissions are paid every time a PUA deposit is made. Meaning, if we make it only in year one, there's a 2% commission. If we make it every year, there's a 2% commission. Every time we make a payment, there's no fees or commissions paid on the overall cash value. It's only on outside dollars, premium and PUA payments I make out of pocket into the policy. That's what generates a commission. Let's take a look at the numbers here. Got to look at the numbers, right? Okay. So on the left, I know this might be a little small here, but I will do my best to highlight everything. We've got our 1090 split on the right, our 25-75 split. Exact same company, product, everything's exactly the same here other than the splits. Both were non-MEX indefinitely based off of non-guaranteed and guaranteed values as well. 5K base premium, 10%, 50K out of pocket. This is what we always talk about. When a policy is properly designed, look at that. I've got about 44,000 right off the bat. Break even point. I'm positive by year 5. Keeps on growing. You're going to find, we're going to look at the cash value side by side so we can see the difference. But the short answer, this one gives much more to the consumer upfront and continues to give more value to the consumer long term as well. So we're optimizing their value in this situation, as we do in all situations. Now, the commissions. We've got the base premium commission. There's the 93%. The PUA rider commission. So the PUA component, we don't have a column for this, is $45,000. There's a term rider in both of these examples as well, but the insurance company pays the same PUA commission rate on this particular term rider. So that's why it is 2% of $45,900 a year. Year 1, the annual commission, $5,500, $5,550 to be exact. And then the total commission, $5,550. What this total commission column represents is we're factoring in all years. So for example, by year 10, the agent has been paid in a combination of first year compensation and renewal compensation, $15,900, based off the client's payments of $500,000. Okay, cash value is $587. Compared to the next example, 25-75 split. Big difference right off the bat. Same out of pocket for the consumer. So if the consumer is not shown different options, because there's a lot of different ways you can slice it other than this, this is 2 of 10,000. But if the consumer is only shown one option, 50,000 goes in, it's the same 50,000 out of pocket to them in any case. Same company, product, health rating, all that good stuff. Difference is really right off the bat. This is going to be the biggest difference, 37,000 compared to just about 44,000. So that's the hit. Base premium commission, 11,625 compared to over here, 4,650. Got your PUAs, total annual commission, right off the bat, 12,000 and change compared to 5,500 and change. Huge difference on compensation. How about cash value? There is a difference. So when I answer that question, do commissions impact performance, and I say yes or no, yes is, yeah, depending on how I design the policy, right? When I minimize this to optimize the consumer's value, what happens? They've got more value, but naturally, a lesser compensation is paid right off the bat. Versus this guy, well, they've got less value up front, but a higher commission is paid up front because the base premium is higher. So that's where I state yes, depending on how the policy is designed. Where I state no is, let's say we went with either of these policies and we said, I am working with an agent, see you later, let me go directly to the insurance company. Well, what would happen here is the policy would perform exactly the same. Again, the company pays an agent a commission for them bringing them that business they otherwise would not have had. Let's progress on. Year 10. So over here, 587 with the minimum compensation, the 1090 split, compared to 563. Right? So you've got about $24,000 more by year 10 with that design, which just so happened to generate less compensation as well. What do we have over here in terms of total commission? $24,750. So it's very close. That's a $9,000 difference is what it is. But what's the difference in cash value performance? About $24,000. Same company here, by the way. We're going to look at the guarantees next as well. And by the way, this is not saying agents are bad for designing policies in a certain way. This is something that consumers have asked, I think, since the life insurance industry has been around. Hey, what's the compensation? And sometimes a consumer, a potential policyholder, is nervous to ask. And frankly, they shouldn't be. Yeah, and that goes on everywhere. If we go to buy a car, like, hey, what are you making here? You know, I want to know because I saw a better deal somewhere else. I just want to know. Nothing against the agent making money. Zero issue with that. We just want to know it. And it does provide more transparency to say, okay, I want to know which one generates the most value. So it's full transparency and making sure that I actually get the best option. Because if I buy this and then find out about this later, I might be upset, even if this was in my best interest for one way or another. That's where the options are critical. Let's continue on. 30 years down the road. Not a huge difference, right? The compensation, 1090 example started to catch up. We're at about 35,000, where this one is 42,250. So there's a difference. It's about 7,500 more I made over in this guy. Why it caught up is really the PUA component. I had a greater PUA over here, so $900 per year were paid in PUA commissions as opposed to over here, $750. You can look at the total, $875 compared to $950. So marginal difference, but over the span of 30 years, I mean, small differences, small numbers add up. All right, now long-term performance. A big difference. This is the same company, by the way. About $13,000 more from start to finish. So some would argue here, well, go with this one because long-term, there's really not much of a difference and the agent can make more upfront. That's true. How I would argue it if I was the consumer would be, well, I've got more long-term and throughout the life of the policy as we look at it, but I've got a much, much greater opportunity cost in the early years when I have significantly more. So why not take the option that always gives me more money, again, as the consumer? Death benefit as well, as you look at that long-term, which one gave me more? Both were non-MECs, by the way, based off of present dividend values, conservative dividend values, and guaranteed values. None of these MEC'd. Okay. Long-term, 11.1 compared to 11.03. About 100K difference in cash value, just about 120,000 in death benefit. Let's look at the guarantees real quick. The commissions here, this is the same product, but just with the guaranteed values. The commissions here are identical. Really, I'm just interested in the performance. So, year 10, break-even point in this example with a 1090 split. Year 13 with a 2575. Seeing a difference here. What do we have, a $13,000 difference? Year 30 on the dividends. What do we have here? $2,073,000, $2,049,000. Right, if we take those, what do we got? Just about 24K. So about double compared to the last one. That was 13K. Not quite, but almost there. So again, this is mainly meant to provide transparency. We stated that individuals we've worked with have gone with 25-75 splits because the particular insurance company they wanted would allow PUA flexibility for a long period of time only with that type of design. So that's where we work with individuals, go over the different designs. Our goal is pretty simple, maximizing cash value short-term and long-term with everyone we work with. Because once we do that, now we've got the asset, we've got the high death benefit as well. Now, whatever our plan is to use it, whatever it might be, whether I want to borrow, repay, use it as a financing tool, whether I want to take income down the road, maybe it's just an asset on my balance sheet. If I've got more capital, more cash value to work with, that puts me in a much better position to do that, provided we MEC test it and make sure we don't run into any kind of issue there. But hope that you enjoyed this case study. I know I always enjoy going into details and appreciate all your questions over the years because that's where these ideas come from. So as always, I hope that this helps. Reach out with any questions and we will talk to you soon. Thank you so much. Hey guys, Steve Parisi here. If you enjoyed the content you just saw, please subscribe, like, and hit the notification bell for future videos. If you'd like more information or to see some custom policies for yourself, feel free to call or email our offices at the contact information below.